are we now? I wish I was kidding with this slide. 2 months out from the end of the transition period, and nothing much has changed from where we were the day after the withdrawal agreement got signed. I'm sure you are all aware that the negotiations have continued behind closed doors, despite attention being elsewhere with everything else that's going on in the world at the moment. You may also be aware that Boris Johnson set himself a deadline of the 15th of October to secure the outline of a final agreement. And sadly, that date has passed with nothing being achieved, something that is really rather familiar by now. And following this failure, Boris Johnson publicly cited continued differences in how to handle fishing rights, the Irish border, and the UK's ability to pass its own laws. And he suggested that these issues were now almost insurmountable. And he recommended that the UK prepare for an Australia-style trading relationship with the EU on the WTO terms. Sorry, I've got a notification saying that there were bandwidth issues with my webcam, so I may turn it off shortly if that notification comes up again, but hopefully you can all still hear me okay. So in response to Prime Minister Johnson's statement about these insurmountable issues, the President of the European Commission tweeted that the EU would continue to work for a deal, but understandably, it would not do so at any price. And the EU negotiation team has actually been in London to intensify negotiations after the last few weeks. But given the increased political pressure domestically on the government about its handling of COVID-19 lockdowns, Mr. Johnson is reluctant to make any further compromises with the EU, and he's been clear that unless Barnier is able to show some movement in the mandate handed to him by the EU member states, there was, and I quote, little to no point in actually meeting in the time remaining. Leaving all of that aside, assuming a free trade deal can be concluded in time, it's fairly certain that it will not include the market access provisions for financial services. It may, however, contain specific articles in a financial services chapter regarding information sharing, regulatory cooperation, and dispute resolution, all of which are prerequisites for a relationship with the EU based on equivalence. But where would equivalence get us? Forgive me if you all already know this, but I thought it was worth going through again, that under Solvency II, the European Commission does have the power to grant regulatory equivalence to a third country, which will be the UK next year, in 3 possible areas. The first is reinsurance, where reinsurance contracts entered into with reinsurers in a third country must be treated in the same manner as contracts entered into with EEA insurers. Group solvency, where EEA groups with third country subsidiaries can use the local capital rules for their subsidiaries located in that third country rather than the Solvency II rules. And finally, in the area of group supervision, where EEA supervisors may, under certain conditions, rely on the group supervision exercised by the third country national supervisor. And in particular, insurers operating in the EEA as part of a group with a UK registered parent undertaking, they may be required to provide a worldwide group solvency or to apply other methods aiming to ensure appropriate group level supervision, including the establishment of a holding company with a head office in the EU. And it's worth saying that the European Commission has confirmed that the assessment of the UK's equivalence is ongoing, but that does mean that the assessment has not been finalised, and it has actually advised the relevant insurance industry stakeholders to prepare for a situation with no equivalence. And this actually seems even more likely in light of comments from Rishi Sunak, who is the UK Chancellor of the Exchequer, who announced earlier this year that the UK government plans to review certain features of Solvency II to ensure that it is properly tailored to take account of the structural features of the UK insurance sector. And this was a clear indication of an intention to diverge from the EU rules, and any such divergence would make equivalence even more challenging, although it is worth noting that equivalence under Solvency II is not a singular determination, but rather it's assessed individually under the three heads that I mentioned earlier. So, for example, the European Commission previously decided that some countries, including Australia and the United States, are Solvency II equivalent for group solvency purposes only on a 10-year renewable basis. Whereas in the case of Switzerland, it was deemed Solvency II equivalent across all three areas. In terms of Rishi Sunak's comments, it's understood that the main areas that are going to be subject to review include, but are not limited to, the risk margin, the matching adjustment, the operation of internal models and reporting requirements for insurers. But I would also flag that the UK regulators are definitely taking advantage of Brexit to implement measures where previously they've been hamstrung by the EU legislation. Probably one of the first examples of these, and certainly a very clear indicator, can be seen in the recent suite of pricing and value measures and general insurance papers that were issued by the FCA just earlier this month. Those papers are primarily focused on home and motor insurance, but among other changes, the FCA proposed amendments to its product governance rules, which go much further than the rules which were originally introduced under the IDD, and it actually commented that it was doing this in light of Brexit. Speaking of the IDD, as you can see from the slide, the equivalence discussion excuse me, on that topic is much shorter, as currently there is no provision in the IDD for equivalence. So moving on to a brief reminder of the passporting rights that I'm sure you're all very, very familiar with. The key point is that with all of these indicators, come 1 January 2021, UK insurers and distributors will not be able to passport into the EEA, and EEA insurers and distributors will not be able to passport into the UK. But the UK has put in place two regimes to allow business to continue without interruption here, which I'll talk about in a second. But what of services going out of the UK? We do understand that the Commission is now under mounting pressure from EU member states most affected by a no-deal scenario to publish additional contingency plans. But the Commission is holding off on doing so, so as not to send the wrong signal to the UK negotiators, and because despite everything I've said, it is still unclear what the final outcome of the negotiations will be. We do also understand that some member states may be preparing to issue additional transitional measures of their own, as we saw in the build-up to October 2019, when it first looked like we were going to have a hard Brexit. And these transitional measures will likely be to mitigate the worst effects of a no deal. But with Barnier continuing to stress the importance of the EU 27 maintaining its unity, we're still going to have to wait to see where that is going to leave us.